Assalamualaikum and hi. Today we will present to you about Mfrs 8 and Mfrs 134 along with our chosen companies which is FAR570 Malaysia and Nestle Malaysia. Our group member consists of 5 people which is Alia, Hani, Sabrina, Sarah and myself Hamida. So first, I will introduce to you about Mfrs 8. Mfrs 8 basically explains how companies should report information on their different business segments. This standard is important for companies that operate a business with a variety of classes of business. It also helps ensure that external reports are consistent with the information used internally by the management. Under Mfrs 8, the Chief Operating Decision Maker or CODM is not a specific job title. Instead, it refers to the person or group responsible for allocating resources and evaluating performance of each segment. Usually, this role is performed by top management such as the CEO, CFO, or even the board of directors. For Nestle Malaysia, there are 2 examples of CODM found in their annual reports. First, the Chief Executive Officer and Chief Financial Officer are identified as CODM because they review the company's segment performance and make key strategic and financial decisions. Second, the Group Executive Board acts as the CODM. The board reviews internal reports and allocates resources across product categories, which aligns perfectly with the definition under Mfrs 8, as the individual or group that receive internal report and make the key operating decisions. Now, for Farmfresh Berhad, the managing director is the CODM. He reviews business performance for each product segment such as milk and ice cream and decides how to allocate resources. Then, the Group Chief Executive Officer is identified as CODM. He monitors profitability and uses internal reports to make long-term strategic decisions, which also fits the Mfrs 8 definition.
Next, I will present a Part A question 3, which is about identifying the 2 types of segmental reports used in the financial reporting, referring to the Farmfresh Berhad, a Malaysian listed company. Under Mfrs 8 operating segment, company must disclose information about the different types of their business, known as segment, to help user understand how the company earns its revenue and manage its risk. These segments are usually based on how the company Chief Operating Decision Maker, which is CODM, monitors their performance and allocates resources. There are 2 main types of segmental report used in the financial reporting. First, business or operating segment, which group information by the product or services. Second is geographical segment, which group information by the location or region of operation. For my presentation, I will focus on the Farmfresh Berhad, which mainly reports based on geographical segment. According to the Farmfresh Berhad annual reports and interim reports, the company identified the 2 reportable segments on Mfrs 8. Number 1 is Malaysian operations, which include dairy farming, meat processing, yogurt, ice cream, and plant-based products. Number 2 is Australia operations, which include dairy farming, production of milk, yogurt, butter, jam, and other dairy products. These are considered geographical segments because they are managed separately and require different strategies. Next, let's look at snippet of segmented information of Farmfresh Berhad. Based on the financial year 2035 segmental reports, the revenue breakdown is as follows. For the region of the Malaysia, we get 92.85% of total revenue. Otherwise, for the Australia, we get only 7.50% of total revenue. This shows that Malaysia contributes the largest portion of the revenue, while the Australia provide an additional growth market for the groups. To conclude, Farmfresh Berhad reports its financial performance primarily by geographical segment, which is Malaysia and Australia, which reflects how management monitors and evaluates the business. The company does not provide separate business segment breakdown by the product line in its public reports. However, it discusses product categories such as milk, yogurt, and plant-based drink in the management discussion sections. Overall, this approach complies with the Mfrs 8 as the segments are aligned with the internal management structures and the decision-making process of the company.
I'll be talking about the benefits of segmental reporting using Farmfresh Berhad as an illustration. We'll focus on 2 key benefits. First, how it enhances insight into the nature of business activities, and second, how it improves our understanding of the financial effects of those activities and environments. For benefit 1, segmental reporting helps users understand what the company does and where it operates, rather than just seeing one total figure. For example, Farmfresh for year 2024 segmental disclosure shows Malaysia operation 700.6 million, about 86% of total revenue. For Australia's operation, 109.8 million, about 14%. This tells us that the business is heavily concentrated in Malaysia, while Australia is smaller but still significant. Why is this useful? It helps investors assess performance and risk by segment. If most revenue comes from Malaysia, local economy of course issues will have a big impact. It also allows cooperation between segments and supports better forecasting and valuation, since users can see which markets are growing faster or are more efficient. For benefit 2, segmental reporting also shows how each segment is financially performing, not just their size. In FAR570 for 2023 report, Malaysia earned a segment profit before tax of 7.1 million ringgit, while Australia recorded a loss of 2.6 million. This tells user where the company is profitable and where challenges exist. For example, Australia's loss might reflect higher costs or weaker dairy prices. This helps users evaluate risk, question management plan for weaker segments, and see how different environments affect performance. It also enhances transparency, aligning with Mfrs 8's goal of helping users understand the nature and the financial effects of a company's operation. In short, segmental reporting gives a clearer, more insightful pictures of a business, both in terms of what and where it operates and how each part performs financially. Thank you.
My name is Edina Binti Shamsani. So next one, I will explain briefly on MFRS 134. MFRS 134 Malaysian Financial Reporting Standards 134 outlines requirements for interim financial reporting. The first one is for the purpose. It provides guidelines for interim financial reporting for periods shorter than a full year, for example, quarterly or semi-annual. Next one is scope. It applies to companies with publicly traded securities on Bursa Malaysia, ensuring they publish timely financial reports. For content requirements, it outlines the minimum content needed in interim reports, which can include a complete or condensed set of financial statements. Next is recognition and measurement. It specifies that the same accounting policies used in annual reports apply to interim reports with provision for handling seasonal income and costs. Next is for disclosure. It requires disclosure of significant changes or events and transactions since the last annual report to keep stakeholders informed. Last but not least, comparative information. It mandates that interim reports include prior period comparative for context and consistency. Furthermore, I will identify 2 significant events and transactions that affect Nestle's financial position and performance since the end of the last annual reporting period. Impact on geopolitical tensions and boycotts. The company's financial performance in early 2024 was significantly impacted by ongoing geopolitical issues, which led to a consumer boycott of international brands and a general hesitancy in consumer spending. This resulted in a substantial decline in net profit and revenue, particularly in the first half of 2024. For the full financial year 2024, net profit dropped by 37% and revenue by 11.8%. The company's Q4 2024 net profit saw a 72.2% year-on-year drop. The weaker performance and market sentiment led to a significant drop in the company's share price, reaching a 5-year low in March 2025. The company's retained earnings and cash position for dividend payments were also affected, leading to a lower total dividend for financial year 2024 compared to financial year 2023. Rising commodity costs and efficiency measures. Nestle Malaysia faced pressure on its margins due to increased input costs, especially for commodities like coffee beans and cocoa. The company was challenged in fully passing on these cost increases to consumer, which further pressured profitability in early 2024. In response, the company intensified its focus on driving efficiency, cost optimization, and a prudent pricing strategy to mitigate the impact. These measures have started to show positive results, contributing to a return to healthy growth and improved profit after tax in Q2 and Q3 of 2025. This indicates a positive effect on the company's operational efficiency and a strengthening of its financial position moving into the later half of 2025.
Today, I would like to present about interim reporting periods for both the current and comparative interim financial statements. Why Nestle Malaysia should provide interim reports? This is because Nestle Malaysia is a public listed company on Bursa Malaysia, and Bursa rules require all listed companies to prepare quarterly financial reports. These reports must follow MFRS 134 to make sure the information is timely and accurate. MFRS 134 also requires company to show both current and comparative figures. The main purpose is to provide investor and other users with more current information about the company and improve transparency and investor confidence. Comparing both periods help users see how the company's performance has changed over time. By comparing each period with last year, Nestle can see trends, track progress, and make better and faster decisions. Interim reporting periods for statement of profit or loss and other comprehensive income. The current quarter is 3 months ended 30 September 2025. The cumulative year to date 9 months ended 30 September 2025, each with their comparative periods from the prior year 2024. The comparison allows users to evaluate whether Nestle profitability is improving or declining. For statement of financial position, current interim period is as at 30 September 2025, comparative as at the end of the last annual reporting period, which is 31st December 2024. This comparison helps users assess how Nestle's financial structure has changed since the last audited year end. For example, whether the company increased borrowings, expand inventory, or grew its retained earnings. Statement of changes in equity, current interim period is 9 months ended 30 September 2025. Comparative interim period is 9 months ended 30 September 2024. The comparison shows how Nestle equity has evolved compared to the same period last year. This helps investors understand how management decisions impact shareholders' value over time. And for statement of cash flow, current interim period is 9 months ended 30 September 2025. Comparative interim period is 9 months ended 30 September 2024. The comparison enables users to evaluate Nestle's ability to generate and manage cash compared to the previous year. This helps assess liquidity, solvency, and the company's financial flexibility. That's all from us. Thank you.